The U.S. president's recent tariff imposition, aiming to protect domestic industries, stands at an unprecedented 25%. Dr. Clark, how does this level of protectionism reflect on historical economic strategies?
Historically, protectionist tariffs at such scales were last seen in 1909. The aim is to shield U.S. manufacturing, yet it may incur retaliatory measures damaging global trade. During the Smoot-Hawley tariff era, we learned how detrimental trade wars could be.
Indeed, but isn't there an argument that this could bolster U.S. industry by minimizing foreign competition, encouraging local goods?
True, it could stimulate local industries temporarily. However, research shows that increased tariff barriers often lead to higher consumer prices and potential shortages. The intended economic boost might be short-lived due to worsened international relations.
Given these potential drawbacks, what forward-looking strategies could the U.S. deploy to balance protectionism with global trade harmony?
A sustainable approach would involve negotiating trade agreements that enhance rather than isolate. Fostering innovation and technology within the U.S. could also mitigate reliance on restrictive barriers, ensuring competitive advantage globally.
China's response with a 34% tariff hike on U.S. imports showcases its strong stance. Professor Li, what economic ripples can this retaliatory measure trigger globally?
China's tariffs are symbolic and substantive as they aim to hurt U.S. exports, particularly agricultural products. This tit-for-tat can slow global growth, reducing overall trade volume. Historical examples like the Sino-Japanese trade wars illustrate potential long-term economic rifts.
Yet, doesn't this pressure on U.S. exports open avenues for other nations to fill the trade void? It seems like an opportunity for, say, Europe's agricultural sector.
That's an interesting perspective. While European and other nations might capitalize on the opportunities, the real outcome is a fragmented trade ecosystem. The uncertainty and volatility could deter long-term investment and cooperation, leading to broader economic stagnation.
How do you see China steering its economy in such a contentious environment, considering its new consumption-driven focus?
China is pivoting towards domestic consumption. This shift lessens reliance on exports, strengthening domestic markets. If successful, it may catalyze regional trade alliances in Asia, fostering economic resilience without excessive reliance on Western markets.
With Australia's reliance on China, particularly for commodity exports, how might these tariffs affect its economy, Dr. Evans?
Australia stands on a delicate precipice. With China's potential economic deceleration, Australia could see reduced demand for resources like iron ore, impacting GDP. Yet historically, such downturns prompted diversification strategies.
Some argue this situation might compel Australia to expand its export markets beyond China. Is this diversification feasible given Australia's existing trade structures?
It's a challenging but necessary shift. Australia must cultivate relationships with other Asian economies and perhaps delve deeper into European and North American markets, as evidenced by past treaties enhancing agricultural exports.
Looking ahead, how can Australia leverage internal economic factors amid these global tensions?
Australia could benefit from domestic interest rate cuts, stimulating investment in infrastructure and real estate. Such fiscal policies, if executed strategically, might counterbalance external trade challenges, ensuring economic vitality.
The Reserve Bank of Australia's potential interest rate cuts suggest an invigorated real estate market. Dr. Kelly, how can these cuts differently impact property values across Australian cities?
Lower interest rates generally enhance borrowing capacities, thus stimulating the real estate sector. However, cities like Sydney and Melbourne might see more pronounced impacts due to their historically high demand, reminiscent of the post-GFC recovery era.
Critics argue that low rates could lead to market overheating, exaggerating property bubbles. Does Australia have measures to mitigate such risks?
The risk of a bubble is real. Yet, Australia has been proactive, deploying macroprudential policies such as lending restrictions which historically curbed speculative buying. Structural adjustments like zonal developments for balanced housing supply are also key.
As we look forward, what are the projections for Australia's housing market amidst these bureaucratic and economic maneuvers?
There's cautious optimism. If managed prudently, the real estate market could catalyze economic growth, offering stability amid global uncertainties, especially as domestic policies strengthen consumer confidence in property investment.